Vietnam banking sector, challenges and opportunities in a rapidly evolving landscape. Over the last 3 decades, Vietnam's banking system has transformed dramatically, evolving from a centrally planned, state-controlled framework to a dynamic two-tier structure comprising state-owned, joint stock, and foreign banks. With 47 banks in operation, the sector is a vital engine of Vietnam's economic growth, contributing significantly to the country's impressive average GDP growth of 6 to 8% annually over the past decade. Yet, despite its progress, the sector faces persistent challenges that hinder its global competitiveness. Dominance of state-controlled banks. 4 state-controlled banks, Vietcombank, Vietnambank, BIDV, and Agribank, dominate Vietnam's banking landscape, accounting for the majority of deposits and loans. These institutions collectively hold over 40% of total banking assets. Agribank alone has an extensive network of over 2,300 branches and transaction offices nationwide, underscoring its reach into rural areas. However, inefficiencies remain a pressing issue. Non-performing loans, NPL, hover around 1.9%, with a significantly higher real figure when including bad debts in Vietnam Asset Management Company. These NPLs, coupled with heavy reliance on state resources, limit profitability and restrict the ability of these banks to compete internationally. Transparency and international standard. A major roadblock to global integration is the lack of transparency. Governance practices, risk management, and financial disclosures often fall short of international standards. While larger banks like Vietcombank have made strides in adopting Basel II regulations, the vast majority of smaller and state-owned banks lag behind, with only a few beginning to prepare for Basel III compliance. Without meeting these global benchmarks, Vietnam's banks risk losing foreign investor confidence. According to Fitch Ratings, Vietnamese banks face a capital adequacy ratio, KAR, of only 8.5%, barely meeting the minimum Basel II requirements, let alone the stricter Basel III standards. Significant investments in governance and technology are required to close this gap and elevate Vietnam's financial system on the global stage. Technology driving change. Technology is a bright spot for Vietnamese banks. With over 74% of the population using smartphones, the adoption of digital banking has skyrocketed. Mobile banking apps like those from Techcombank and VP Bank, and e-wallets such as Momo and ZaloPay, are reshaping how people interact with their finances. These platforms are also critical for financial inclusion, with microloans and tailored services helping rural communities and small businesses access capital. In 2024, Momo alone reported over 30 million active users, highlighting its pivotal role in transitioning Vietnam to a cashless economy. Despite this progress, challenges remain. The adoption of advanced technologies like artificial intelligence, AI, blockchain, and big data analytics is still limited. Cybersecurity is another area where banks need to ramp up investment, especially as digital adoption grows. Looking ahead, to remain competitive and achieve global relevance, Vietnam's banks must address fundamental challenges. Transparency, stricter governance, reducing NPLs, and fully adopting Basel III standards are critical steps forward. The government's ongoing push for digital transformation and financial inclusion will also play a key role in modernizing the sector. Vietnam's banking system has come a long way, but it remains a work in progress. With the right reforms, the sector has the potential to not only drive domestic growth, but also establish itself as a significant player on the global financial stage.